Hey guys, Gerry here from the DeFi Alpha Gaming Guild. Quick update on White Whale on the Terra ecosystem. It's a protocol I'm quite excited about. Just thought I'd go through a few of the details and why I'm quite bullish on this project long term. So what is White Whale? White Whale essentially is an arbitrage protocol. So the idea is when there's a price discrepancy between two sources on the same asset, there's an arb opportunity where you could buy on one exchange, for instance, and sell the same asset on another and pocket the difference. So given that Terra is based around UST, the stable coin based on US dollar, we want to keep that as close to $1 in value as possible. So arbitrages are actually incentivized to restore that peg or keep that peg. So this is a decentralized protocol that does all that for us with our funds that we can pull. And it does capture a little bit of value along the way. So that's what makes it basically a viable protocol that could generate income over time. But that's just one example of what you could do with arbitrage around UST. There's a whole bunch of other things that they could do as well, like delta neutral positions within the mirror protocol between different synthetic assets. That's just another example, and there's going to be so many things to arb in the Terra ecosystem. Right now we already have 3 decentralized exchanges in Loop Finance, TerraSwap, and Astroport. So just between those 3 sources, there's going to be arbitrage opportunities between every asset that's on them, not just UST. So it's a pretty exciting proposition. There's not really anything else out there in DeFi, in other ecosystems that I'm aware of that does this type of thing. I think RookDAO might do something similar on KeeperDAO on Ethereum. But I think what that does is allows whales to come in and make big transfers and not incur much slippage because it can be arbitraged away. And the White Whale team have already said that they're going to try and emulate that themselves. So you'll have basically a service for whales, for big players to come in and move large amounts of money around and not have too much slippage. And the protocol would benefit from that. It would capture some of that revenue and return it to the treasury. So if we have a look at their light paper, it explains a bit more about how they do that and how it captures value. So there's a lot going on here, but I'll try and keep it simple. Basically, the concept is that a user comes in and deposits UST, the stable coin, and it goes into a war chest, which holds everybody's pooled funds together. And when there's an arbitrage opportunity, the smart contracts that this is based on will implement what they call a flash loan, which basically in a single transaction that will take money out of the war chest, it'll implement the arbitrage, and it'll return the funds back to the war chest plus the profit that it's just picked up within a single block, within a single transaction. And to make sure that is effective, it checks the total balance of the war chest before and after. And if it's less, the war chest is less than before, it won't implement the strategy and the transaction will fail to protect it. So the idea is it can make lots and lots and lots of little transactions, picking up a few percentage points or fractions of a percent generally on lots and lots of trades and lots of assets, and over time it generates yield and captures value. So it also captures a bit of value from the users directly who are using it. So you basically incur a 0.1% fee when you withdraw your funds from the protocol. But if it's sitting there and it's getting above average returns, you're more than happy to lose 0.1%. The really beautiful thing about this is your war chest is actually deposited into the Anchor protocol, and it's always accruing some yield because you can get up to 20% yield on the UST token. So it's not just sitting idle. It's always earning interest for you and for the protocol. And then when there's arb opportunities, it has a lot of liquidity it can throw around to help create those arbs and to maintain them and generate even more value for you. So it auto compounds that. And when the user withdraws their UST, they end up with more than they started with because it's been accruing yield the entire time. Some other elements here as to why you'd want to hold the whale token. You don't need to be a whale holder to use the protocol. It's open to anyone. But if you wanted to stake your whale token, you get some of the yield that it generates. And also the arb here generates yield into the war chest. So the protocol will accrue value. It's going to have lots of assets over time. And it's going to be a bit of crypto portfolio over time, essentially. This bit over here, whale bonds, that's a little bit complex, but if you're familiar with the Olympus DAO protocol and protocol on owned liquidity, that's how this works, is a user deposits basically an LP token, so they'll have to provide some liquidity. So i.e. market buy the whale token and pair it with UST, provide it to TerraSwap, they get their LP token, which represents their share of the pool. They deposit the LP token, and then in return for all that effort, they get more whale tokens than the value of the LP. So you're getting whale at a discount once you've done that mechanism. The reason they do that is the LP token goes into the war chest and the protocol owns that liquidity, which is going to be a big thing in 2022. It just means that protocols are going to have a constant source of revenue. And whenever someone is swapping between their assets, between the native asset, in this case whale, and probably UST or even Luna, then these guys, this protocol captures the value. And if you're a holder of it, then you can get in on that action, essentially. So that's sort of how it works at a high level. The other things I like about it is during their liquidity bootstrapping pool, which was an interesting way to bootstrap their token, it sort of provided an environment where you're not going to get front run by bots. It was a much more of a fair launch and true price discovery before the token had actually launched. So I won't go into too much detail about that, but I will say that basically the average buy-in price was 27 cents, I think. But some people paid up to $1.14, mostly bots, right in the first few seconds of it going live. And some people timed it really well and managed to get some whale tokens for 13.1 cents. So just to give you an idea of what people have paid to get in on this, on the action. While we're on that vein, this is the current price right now. It's taken a pretty big pullback today with the market-wide downturn, and you can see it's dipped down below. It's currently below the average price that people paid. So it's not a bad time to get in, and there isn't much dilution of this token going on. There's not more token being issued like you would expect most other protocols. Also on that point, this is their 5-year inflation schedule. It's going to change slightly because this is all still evolving, but most of the token and the vesting for the team and the private investors, that doesn't start till the second year, which helps keep a bit of a price floor. So hopefully things don't dump down. You're not getting dumped on by VCs and whatnot. And they've built in a lot of mechanisms to make it a sustainable protocol that incentivizes people to hold rather than to sell. So one way they do that is using the similar model to what SushiSwap has done, where you've got X whale. The idea there is that you stake your whale token and then you receive more whale as an incentive. The bootstrap pool, when they first launched this, was so successful that they decided they didn't need to start doing airdrops. So all this, basically, you could almost change that from airdrops to incentives for stakers, basically. That's more or less what they've said. On top of that, if you're familiar with Curve Protocol and lockups, and Astroport did this recently to a certain extent, if you lock up your X whale for a period of time, you'll get even higher incentives to do so. So obviously, if you've locked something up for 24 months, you can't sell it for 24 months. So that takes it out of the circulating supply. And if the demand ticks up, there's less whale on the open market to buy. So that's always encouraging for long-term prospects. The last thing I wanted to mention is they're talking about this concept of using VUST. So we go back here. When you deposit your UST into the Arb vault, you'll get issued VUST, which is basically your IOU, your receipt, if you like, of what you've deposited in here. But they're going to make that composable within DeFi. So the idea is, what they're floating here is that a user will be able to deposit VUST into the protocol, and then they're going to use VUST as the primary trading pair to trade in and out between whale and VUST. So if we go further down this tweet, it explains that, why this is important and why it adds value to the holder, which is quite interesting. But to summarize, basically, it means that you're going to be picking up a lot of incentives. Effectively, you're keeping the peg, you're earning anchor rewards from being in the anchor deposit, you're getting the arbitrage yield that's generated by white whale, you earn the swap fees simultaneously, which would probably be from TerraSwap. And so you're getting, yield on top of yield on top of yield here, potentially, which is a pretty good place to be. And the other thing that makes it very interesting is that VUST is designed to spike in times of volatility because there's a bigger arbitrage when people are moving lots of money around and you've got a volatile market. So VUST is going to go up. So the value of VUST in the pool is going to go up. And with any pool, liquidity pool, it needs to be equally weighted. So the whale token is going to have to be bought up to fill this pool back up. So you're going to have positive price action on the whale token based from this mechanism, especially during times of volatility. So at the moment, the market's a bit of a scary place. Things are dumping, but something like white whale is going to thrive and it's going to pick up a lot of arbitrage and a lot of volume during times like this when you've got a very rocky market. I mean, just in that day there, you can see there's a huge dip down to 16 cents and it bounces straight back up to 18. So that sort of market, the spreads between certain assets widen, and that's when an arbitrage is most effective. So anyway, that's my 2 cents on the protocol. I think it's a really exciting one with really good long-term tokenomics. So if you're interested, have a look. The last thing I should have mentioned is if we go to Gateway Pylon Money, there's a nice safe way to invest into this if you're a little bit risk averse and you've got a longish time horizon. You can come into the Pylon pool on Whale. Pylon's basically a launch pad that uses your anchor yield to invest in tokens. So you could deposit UST, lock it up for 18 months, for instance, and you get 60% yield paid out in Whale tokens. And after the 18 months is up, you get your original money back as well as the Whale token that you've earned. So it's a really attractive way to have low risk farming of this token. And I'm guessing in 18 months' time, there's a real good chance this protocol will have some decent momentum, and who knows where the price could be by then. So not financial advice, of course, but it's just another option to consider rather than just coming in and market buying this. But full disclosure, I'm doing both. So anyway, guys, hope that was useful. Thanks for watching.